Hey, good afternoon, everybody. This is Paul Asmar from CamelbackTrading.org. It's Sunday afternoon, and I've decided to make a video. It's going to actually be probably more of a webinar that I hope is going to be very helpful for all, both new traders, experienced traders. I've been asked to do this by people in my room. It's going to be rather long. It's not something, one video you watch once. Hopefully you save it, you go through it, take your time. I'm going to be using a lot of the definitions and explaining them. I'll go slow where you could write down the definitions of them. It'll be easier for you to write it down in your own words. I'm going to go over a ton of different trades just in these past 2 weeks alone. So let's start off with this. A lot of the things in this video, so a bunch of them are my own, right? You're not going to find them in a market profile book from Dalton or anybody else. There are things I use that other people don't use. Just like everybody else, one of the things I tell people in my room is, whatever works for you, you shine it up and you go with it. I'll never make fun of anything anybody uses. So there might be a lot of things in this video you might not agree with or want to use, and that's fine. I want you to take bits and pieces away from hopefully things that you see me do that you think are valuable to you. I'm going to start basically from before the day even starts through the trading day and after the trading day. And in between, give you a lot of different explanations of terms that I use. So let's get started. First things first is, and I know a lot of you have heard a lot of this before, but I'm hoping a lot of new people watch this video, but I do have a preparation sheet for the day's trading. First and foremost is, and I do homework in the old-fashioned way on with paper and pen and pencil, and I write down every day. Actually, I do it at night in my homework, and then I go over it again in the morning. 3 destinations for both the upside and the downside, and also what the market did that prior day and or didn't do. Remember, a lot of times what didn't happen in the market is more important than what did happen. So the reason I write these destinations and reference points is because when you go to place a trade, that's what you want to know. Where the first thing is why I'm taking that trade, what my out is if I'm wrong, and then third, your destinations and reference points to get to. Some people might have only one destination. Some might have 3 or 4. So especially if you're taking multiple contracts, you could always use the 3 destinations you put as those targets. And they change throughout the trading day, of course. But you have to have them to start, whatever they may be, whether it's a overnight high, a daily high, a wide POC, things of that nature. We also have to know what the charts are telling me. Even though we're day traders, it's still going to help if we know the market is either down or in balance or one time framing up on the daily, because it's going to help you in your intraday trading as the market's evolving that day. So you always want to know what the monthly, weekly, and daily charts are telling you. And another really important thing, what is your overnight inventory? Is it long? Is it short? Is it neutral? And more importantly, what is the context of that overnight inventory? We talk about this a lot in my room. There's a lot of times, and we could show, and I'll show examples where the market sold off late in the day for the last 6 time frames or so, and it was nothing but people shorting. Well, if they don't get much for their efforts, what's going to happen? They're going to take those back. So a lot of time the next day, if you're opening it up, say, above an afternoon rally high from the previous day where they were doing all that shorting below, yes, the overnight inventory is long, but in context, it's really just short covering. So if you're not getting any new money into that play, it might eventually make the market weaker, and more importantly, you might not get that inventory adjustment because the market's not truly long. It says shorts covering. You might even get continuation of that. So that's very important. Where will value build today? Value is way more important than price. So that's something I'm always trying to figure out as the day is going on. Who am I competing against? Long or short-term plays. I can assure you, 90% of our days are dictated. Remember this is key. Dictated by short-term traders. I'm not saying long-term players aren't in there. They're in there every day. Of course they are. In every stock. You have funds getting in, funds getting out. But who's really dictating the action? Most times, it's short-term retail traders such as ourselves and mindless algorithms that just get set to very, very visual points. Our destinations and reference points. As the day forms, we start putting in our head, will we be rotational? Will we be trend? The indices play a big role in that. If it looks like we might possibly go trend, say to the upside, well, if the markets are basically flat, if value is only unchanged or overlapping a higher, it's not going to be as good as if value is clearly higher from yesterday. If the indices are up 0.5% or 1%, that's why everything is put into context. Will we have a P shape for short covering or a B shape for long liquidation? All of these things are going to help determine if the algorithms are accommodating and readable that day. Now, another thing, and you all know, most of you know, news to me does not make the market makes the news. But there is no doubt there are times when a headline or something like that comes out and they increasingly get the algorithms agitated and frisky. When that happens, step away. There is no reason to trade. If you're trading for a living, there's no reason to trade during those times. Okay? That leads to you have to know yourself best. Then you have to know your competition and know the product you're trading inside and out. Okay? I also wrote M period is very unpredictable. Right? For those of you in my room, we call the last three time frames KL and M the Three Stooges. Curly with a K, Larry and Moe. They are, especially Moe, is incredibly career wrecker. So again, a lot of times that day of, the move it makes is very unpredictable, but it helps the following day and or days. Okay? So that's how I start my day. Then when the market opens, and now we're going to go into these trading days and what I look for. I like to say, and we're starting with March 9th. March 9th turned out to be a day with no conviction to start, to a powerful afternoon pullback low, and a price probe. So what happened that day? Well, we always have to look at the prior day. The prior day, the market attempted to go higher, failed, ended up with an 8-wide POC, and M period absolutely flushed out. We didn't probe, but it flushed out. So the next day, though, the market opened, basically, even though we finished all the way down here. Look where we closed that day, at the lows. Look at the next day where we're trading. $10 higher. $10 higher, just below the base of the price probe. So everything the sellers tried to do in M period that day was for naught, right? Didn't mean anything. However, in the first 2 hours of trading, we had total lack of conviction. We did have higher value. We had higher value to start the day, but we went back and forth through the opening, and a lot of you people in the room know how important that is to me. To me, and this is why the initial balance, I know to some people isn't as important anymore, but to me it's critically important because I like to describe it as a boxing match, right? We're in a 13-round boxing match, A through M. Well, A and B, a lot of times, is a feeling out process for the buyers and sellers as they're boxing each other. Sometimes you get a clear knockout when A just rips higher and B continues and vice versa, but a lot of times you're going to get this, a feeling out process. And that's where the opening is so important because eventually, when the opening is won, you'll get your direction for the day. So look at this day. And this is where the profile paints such a visual picture. So we open with higher value. We pushed down though. We pushed down. Never got to the previous day's value. We did get below the base of the price probe again, which was obviously rejected big time because where we had, well, I shouldn't say that. We closed lower. It was still rejected because now where there were buyers in, oh, you know what? This isn't, I apologize. This is not a price probe. Totally apologize. I thought that said M period. I'm like, here's M period down here. So forget that. We didn't probe, but we opened inside of balance. Right? I always write this down. Where did we open? Where are we opening? We're opening inside balance but above value, because all these things have very different meanings. If you open in balance in value, it's the worst of your risk reward. Well, we're opening in balance, but it's at the top of yesterday's range, and it's with clearly higher value. So we had pretty much a nice bit of excess yesterday. Now remember, excess ends one auction and begins another. Now that auction might last a couple hours, it might last a couple of days or a year. So look at this, what happened in that previous day. And I know I'm jumping around a bit, but I think this is so critical when you break it down like this. We had tremendous push up in H, but we had excess. Look where I opened. Nowhere near where H's high was. So if excess ends one auction and begins another, well, buyers got rejected here. Major league, right? What happened? Well, I and J pushed down pretty good. They tried to rally them in K and L. Look at this. We didn't even get I's high, let alone anywhere near the excess. And then we rolled over and went to the lows of the day. So when we talk about excess ends one auction and begins another, well, look at this. The high of the day was 427. M period's low is 416. That's $11. To me, that's a pretty good new auction to the downside. So that's a beautiful example of excess. However, it only lasted one day. The next day, look what happened. We opened right below it, so we still had the excess. We tried to test down, but never even get. Remember, the day before, that's where I got to, K, L. We couldn't even take out I's high. Well, now look at this. It's a totally different story the next morning, isn't it? A went down. We tested below I and L's high, right? Never got to K's. Look at B period. B period never even got to I's high. So all of a sudden, that excess that we were talking about that proved so fruitful for sellers the previous afternoon, now is in a little danger. And here's where the uncertainty was. A went down. B went up. C, look at C. C took back a lot of the excess, but we never took out the day's high. It's another factor to keep in mind. ES and SPY play tremendous games at the previous day's highs and low. Russell and Q's, they don't seem to have any problem at all taking it out. We do. So look what happened. We got close in C, didn't take it out, and then D said whoever was long in B and C, well, we're going to shake you out. But again, look at D's low. Never got close to here. So something was changing. We took back all the excess from the previous day. We had higher value. And now look at E period. We always talk about nuances. So the IB to me is very hard. And IB stands for initial balance, the first hour of trading. Plain and simple. That's what it is. After the IB, I want to know which side takes it out. I think it's very important to start getting, I have a checklist sheet that we'll go over that is critical to me as far as who starts taking control of the day. Well, we have higher value. That's a check for the buyers. We got the overnight high. That's a check for the buyers. C took out B's high, so that's the initial balance. That's a check. So things are starting to work for the buyers. Now we look for nuances. Well, what's a nuance? We couldn't get to these previous highs, which the day before was detrimental to the buyers. They couldn't go higher. Now it's detrimental to the sellers as they can't get below it. And now look at E. For the first time in 2 hours, we never get the opening. Nuance. Then E goes and takes out, finally, the day's high. So when these things start happening, it tells me we're getting more and more confidence on the buy side, and you can look for longs. Now, you saw what happened after that. Once we took out the day's high, F and G even pushed higher. Now, I don't recall, we did have single prints, as you can see, initially. We did have single prints right there. It's just a little one, but we had single prints in F. So a lot of times I talk about the ebb and flow of trading in my room. And what that means is, even though we were trend here, and that's another thing we'll go over, But I don't chase. I'm not chasing E's high, F's high, G's high. If the market goes away without me, that's fine. I don't have a problem with that. But if the market pulls back, especially when you have higher value, especially when the indices are up, you took out the IB high, you took out the overnight high, the checklist is overwhelming in favor of the buyers. So the ebb and flow, it's like the ocean. The waves come in, the waves go out. So every time the market pushes in a little bit, you could certainly be taking longs. And you're using the previous time frames low as you're out. So that's what I mean by the ebb and flow trading. So then what happened? After G, H couldn't take it out, and H actually stopped the one-time framing up and filled the trend day. But because things are so much still in favor of the buyers, and this is where context comes in, and what this is some of my favorite trades. Yes, we one-time frame down in I. Now, before I get to that, one-time framing to me, in B period, if it takes out A's high or low, I consider that one-time framing up or down because it's the first time frame that could happen. After B, I want 2 time frames in a row. Otherwise, to me, it's just balance. Because I think it's silly to say if C takes out B's high, we're still one-time framing. Granted. But look, D took out C's low. To me, we just stopped the one-time framing up. We're not one-time framing down. Because think of it in this concept. Some people might say that's one-time framing down. Then E takes out D's high. Well, what are you doing? One-time framing up. And then if F took out that, you're one-time framing down. So I don't consider that at all. I need 2 in a row. So even though we're one-time framing down, and people in my trading room will say, well, why are you buying this here? Why would you be looking for a long in I at that time? And there's many reasons. Many reasons. First and foremost, we have to go through everything we just said. We have higher value. Indices are higher. We took out the overnight high and we took out the IB high. That's 4 very powerful things. Another powerful thing, POC is starting to get raised. Our point of control is down here, 4 wide. Well, right now, up here, it's only 4 wide, but unless we get all the way down and get 5 wide here, I'm expecting it to get raised. That's my expectation, which it did. So when it comes back to here, now halfback obviously wasn't here at that point because halfback came higher after L&M went higher. But again, with all those things, yes, we're one-time framing down. It dipped its head into the IB range. But on a play like that, I'm absolutely looking for a long. And then again, I don't know what value low was at that point because it just shows the whole day. But I would use value low as a very good guide also. So why did the market come in? Because the market got too long. Remember, here's a stat you're going to like. 85% of trades overlap. Think about that. 75% of trades are inventory imbalances. So the market got too long here. Yeah, we had single prints, but very small. They filled. Once you took out G's low, what happened? The weakest of the weak get out. So whoever was long in E, F, G, especially, maybe not so much H, but once I took out H, they got out. And that's all that is. It's an inventory adjustment. So that's why I was comfortable on that long. And then we go and we probe. Now, let's keep something in mind. There's a difference between price spike and price probes. I will be going over them. Price probe is really my thing. To me, a price probe is when you make a new high or low on the day, strictly in the last half hour. To me, the market is probing. We don't know if it's really accepted or rejected to the next day. There's a lot of times the market will probe, and then we, in say at 3:40 in the afternoon, and we close below it. I'm still not saying it's rejected until the A period of the next day. Okay? All right. Now let's go. That's a perfect example of a day why I was so confident looking for a long with everything I just told you. Now let's go to the 11th for an afternoon rally high. Now here's a day. The market gapped higher from the previous day. So here's another, we price probe too on the 10th. So here's a perfect example of what I just spoke about. We price probe. We made a new high in the last half hour. Look where we closed, below K's high, which is the base of the price probe. But look where we opened at 9:30. Price probe accepted. Anybody who bought above K's high and held it overnight made money, or could have made money. We gapped higher. The gap didn't hold though, right? It filled in B period. So the market, even though it was strong last night and again early in the morning, week long started getting out. B period filled the gap, and then we started pushing lower. Not a lot, but they tried. B went down, C inside, D inside. So look at this. And this was, I remember this day, this was a huge nuance I told the trading room. When D got up there, I'm like, look at this. Look how we can't get above C's high to stop the one-time framing, because B one-time frame down. C was inside. That doesn't stop it. D was inside. So the market was building energy. The question was, which way? If we took out D's high, the market probably would have popped pretty good, because you would have had a lot of people who were short get stopped out here, B, C, D. But instead, the opposite happened. People were also buying down here, right? It looked like people were getting trapped. Shorts getting, you could say shorts getting trapped up here. Well, actually, you would say short. The market up here, people are shorting it. Right? I said they're going to do its work till it doesn't work anymore. Well, when C couldn't take out B, people started buying it. Same thing in D. But at some point, that's not going to hold. So what happens when E took out B, C, and D's low? Everybody who was long got out. And more shorts piled in, because we were still one-time framing down. And it created this price movement to the downside. It's not like the market's bad. It's not. It's short-term traders, and this plays out over and over again. So the market was still short, but whoever was buying it down here, once E broke, the market got even shorter, and these longs got out. Then what happens? That process stops, and we trade sideways. So the market starts getting too short, but now they're not getting paid. So the market finally takes out G's high. And what's going to happen? Anybody who is now short in E, F, and G's lows, cover. And now I look for the afternoon rally high. Now this isn't a textbook one for a couple of reasons. First and foremost, to have a textbook afternoon rally high or afternoon pullback low, you need single prints to hold that day. So again, this is my definition of an afternoon rally high. Also that day, value was still overlapping a higher. So when value is overlapping a higher, the conviction for an afternoon rally high isn't as great as if the value was totally lower and the indices were down a lot. This is where we closed the previous day. So when I came up, the indices were basically unchanged. Now it turned out to be a nice afternoon rally high, but it's not with the greatest conviction. Also, we're going to go over the diffusion model, because I think this is a perfect example of it coming into play. So the diffusion model, give me 1 second, because I want to get it exactly right. So first you have the innovator. If you shorted H or I's high, you are the innovator. Why? Well, you're one-time framing up. I was an innovator on this trade. We were one-time framing down, but I innovated with a lot of powerful things in favor of the buyers. We talk about context, so keep in mind what we're saying. There's a lot going on here in my favor. POC being raised, everything we went over. I won't go over it again. So I did that along with confidence as an innovator. Could have waited. You could have waited today, take out J's high. You're still going to make good money, right? K, L, and M. But the innovator has the highest risk but best reward. So if I bought it here, and I'm holding on to it, which is another story, but again, a lot of people do, look at the reward they're getting from here to here as opposed to here to here. So on this trade, again, you're the innovator. Now, it's not as confident an innovator trade because the indices are only flat and values overlap into higher. So it's the biggest risk, but the most reward. Okay, So instead of the innovator, maybe you're the early adapter. Well, what's the early adapter? Well, how about J period? J period goes up, but doesn't take out I's high. So now you have, when you're the innovator in I, where's my out here? Is it value high? Is it above here? But here, as an early adapter, you take that short, you could use I's high as your out. So maybe you're the early adapter. Then K happens. Again, doesn't take out J's high. Now, wait, before I get there, J takes out I's low. So now we're back to balance, right? We stopped the one-time framing up. So now in K, when it starts going up, you have a little more confidence because you stopped the one-time framing. Good risk reward to take a short against J's high. Still, possibly late early adapter starting to get into the majority. Now K starts coming in. K takes out J's low. Guess what? You're getting the majority to rev it up now. Why? A lot of reasons. You're now one time framing down J and K. Ooh, look at this. We just took out the day's low. Okay? We hadn't taken out the IB high or low yet, had we? I'm sorry. We had taken it out. We only took out the IB low. We never got the IB high. So now K takes out the day's low. So now what do sellers have in their favor? One time framing down, took out G's low, longs trapped. Now the majority starts pouring in. Majority's pouring in. Then you start getting the late majority. M starts, can't get back up, starts going in. Now they're like, well, we're going to zero. So now they start coming in. And then you get what you never, ever, ever, ever want to be is a laggard. Now, I don't know if these are the laggards at that point. But when you're selling at the lows of the day, you don't know, right? We closed at the low of the day, so you really don't know if they're the laggards or not. But that is a perfect example of the diffusion model, where if you took that short, that's a great, well, not great, it's an innovator short. The best short is, like I said, as the early adapter in J against I's high, or as soon as J takes out I's low. Okay, so that's the afternoon rally trade. Now, let's go to the 14th. This was a trend day down where shorts got tremendously trapped, and I got hurt really bad that day. So, what happened that day? Well, what happened the day before? Right? We said you don't want to be a laggard. Well, the market opened below the base of the price spike. We went out with a trend day down and a price probe. So sellers are very comfortable. We opened in the price probe. So these shorts were still okay. But then what happened? A rips up, gets right to the base of the price probe. B opens up, takes out the to go one time framing up and fills the trend day and now is in the upper distribution. C goes higher. D goes higher. I'm like, wow, they just took back. Remember, we opened with lower value. But by this time, value was basically unchanged. Maybe overlapping low, but I think it was unchanged by that point. We got the 7 wide POC. So what's left? The afternoon rally high. So when D backed off, now remember, yes, value was still either overlapping low or unchanged, but we had gotten the IB high at that point, so buyers were starting to take some back. So when E took out D's low, I thought it would be a decent point to start getting long. Well, that cost me because I added to it. Now, we never went trend until G, right? We didn't even take out the day's low yet. Remember, we had taken out the IB high. The odds go down dramatically to take out both sides of the initial balance. But this year has proven to be a lot different. I don't have the stats, but man, I think it might be closer to 50-50 than 75-25 not to take out both sides. So when we took out the IB low now in F, I was a little concerned. But look, we even rally. Look at G even rally. But anyway, not talking about my trade. I want to talk about what happened here, about the different types of days. So we had a trend day down, right? The G, one last attempt in G, But we never stopped the one-time framing, so there's no afternoon rally high. We went trend. And then what happened? F, G, H, I, L attempted one gasp to get into the single prints, failed. Now, M did not price probe, but look where we closed. So when we went home that night, even though it was with a trend day down, it seemed like shorts were trapped. Why? Well, look, we always talk about the further you get away from a time frame's low or high, that means the trend is young. G got pretty good distance away from F. H, not much, but then I got good distance. So the sellers were strong. And then what happened? Look at J and K. And I think ES even had a poor low. J got nothing, poor low. L never even made a new low, and neither did M. Those are all little things. Yes, they lowered POC, but those are all little nuances that the next morning, if we opened above L's high and or certainly above A's low, everybody who sold, who shorted from A's low down is trapped. And what happened? Look where we opened. Above that, they pushed down one time. The single prints. Remember, you don't have to trade in those single prints. Once we open up here, those single prints are gone. It's not like a wide point of control. If a wide point of control is an upside destination and we gap above it, you don't just take that off your sheet. It becomes a downside destination. But with single prints, and single prints are a form of an intraday gap. So once we opened above them, they're gone. Look what happened in A. They tried to get right to double distribution day. This day was being treated as two separate days, from L's high to the day's low, from F's low to the day's high. So we opened in the upper distribution, came back in, didn't even get to the lower distribution. So whoever was still trapped, look at this. Once we took out A's high, the race was on to get me out of those shorts. Okay. And we price probed that day too. My goodness. Now, let's go to the 17th. If I could find it. Here we go. So the 17th was a trend day up or the price probe. The next day, we went out with a price probe. Now we opened below the base of it. So it was rejected. However, we didn't even get to the wide POC from that day, which was 9 wide. That's a nuance. Look at B period. Even after it got rejected, we finally took out the day's high. One last gasp by sellers in C period. Stopped the one-time framing, but never got to the opening. Still spent, right? The whole day the morning just spent in M's range between the base of the price probe and L's high. And then finally buyers got their legs. F period explodes above the initial balance. You see this? People say, well, why is the initial balance important? Well, here's a perfect example. Your initial balance is A and B period. A was the low of the IB. B was the high of it. Look what we did, friends. C period inside, D period inside, E period inside, right? We couldn't take out either side. Look at F, though. Look at F period. What happens once we took out the initial balance? Explodes. F, G, H. H tried to pull back. Look at that. Held single prints. H, I. They tried to pull back a little more. Held another set of single prints. And then boom, go out with a price probe. So for people who say that the initial balance isn't important, I think this is a beautiful example to me, as to why it is important. Okay? Now another thing to keep in mind. Single prints are totally different from buy tails and sell tails. These are single prints. This is a form of an intraday gap. Right? F period. Form of an intraday gap. H period. That's totally different than this. This is a buy tail. It's still powerful like single print, but it's not single print. It's a buy tail. Okay? Very important. And another thing, I know I told you I'm going to be jumping all over the place, but I think it's important. I'm trying to get, where was that day that we gapped higher? Well, we'll get to that. Because I want to talk about gaps. Because there's some things that I believe people believe that I think I would not think that way. But we'll go over that. Okay, so this day on the 18th is a trend day up with a textbook afternoon pullback low, a price spike, and a price probe. Wow, that's a mouthful. What do I mean? Okay. Even though we traded sideways here, it was rotational for a while, wasn't it? But look at the things. This is such an important thing to look at. To visualize this when it happens again. We never saw the opening, did we? So even though once B popped, and B popped pretty good, but we never took out the day's high, previous day's high. I told you how much trouble we have in it, in ES and SPY. And then what did we do? C, D, E, and F. We rotated. For the most part, rotated. What does that mean? Well, buyers got too long, never took out the high. We alleviated, C went down. Then D went up, rotate. E went down, rotate. E went back up, and F went up. So do you see why I would never call this a trend day yet? Yes, B is one-time framing. C stops that. I'm not calling that one-time framing down. Because if you do, then you have to call D one-time framing up. Then you have to call E one-time framing down. That's nonsense. This is balance. Until you get two in a row. Now, E had a reversal bar. E took out D's high, second. And a reversal bar is strictly, you took out the previous time frame's low and the previous time frame's high. So E took it out second, and then F took out E. Now you're one-time framing up. But this is a beautiful example of rotation. The market did not know what it wanted to do yet. It wanted to trade between the previous day's high, the base of the price probe, and L's low. So they were rotating in that area until they decided what they wanted to do. However, there was a huge nuance. They never got to the opening. So once we got above it, we went trend. Now, what's a textbook afternoon pullback low? I said you have to have single prints. Well, look at this. Here's your single prints in G. The market got too long, GHI. J tried to pull back. Didn't shake out many longs though, did it? And then it resumed higher. So that's a textbook afternoon pullback low. Okay? Then we had a price spike. Well, what's a price spike? Well, price spike to me happens later in the day, J, K, or L. Well, even though we were trend, the market spiked, but we were still coming back a bit. Not in L. L spiked above K, never looked back. That's a price spike. And then had another set of single prints. So that's a triple distribution day, and then probed. Now, a lot of people will call this the same thing, just the price spike. They don't care about L's high. Again, that's my thing. I like to use that. And we closed at the high. So that was a beautiful example of a trend day up with a textbook afternoon pullback low, a price spike, and a price probe. Now let's get to the 22nd. This is another thing that I use. It's mine, but it's this was a day with a lowest accepted price, an afternoon pullback low, a wide POC, and a price probe. Wow. Again, a lot of mouthfuls. So what does that mean? Well, after that day, we didn't gap higher. We didn't open above the previous day's high. But we opened and basically drove straight up. Now, what is the lowest accepted price? Again, this is my little thing I use. When A period closes, if B period opens, right where basically A closed, and either goes straight up or comes in maybe, again, it depends depends on the range of A. I mean, if it's a $3 range and B comes in 20 cents and then goes straight up, as opposed to if the range in A was only 70 cents, if B comes in 20 cents, not going to use it. It's a moot point. So it is context, but it shows you how powerful the move is in B period. And if it does become what I like to call a LAP, or lowest accepted price, LAP, generally you will go trend and hold it. Because if it was that powerful when B opened to either not come in at all or come in only a couple of cents and go straight up, this market should continue up the whole day. And that's what this did. Now, generally with a lowest accepted price, we get more than one set of single prints. Now, we did have a second set in C, but they filled. But we did hold the single prints, and we did hold the lowest accepted price. And I had a huge trade on this day. Why? Well, just like the other day. Let's go over it. We had higher value. We took out the overnight high. We took out the initial balance high. We had indices that were up. We had a lowest accepted price. You keep going on and on without checklists, and it shows you, even though we're one time framing down, we raised POC, right? All those things. Even if POC was here at the time, I'm not looking for a new high in the day. I'm just looking, if anything, to go back to where POC is, especially if I'm taking good size. And on these trades, I'll generally take 50 to 100 contracts on the calls. And I'm using either the single print fill or the lowest accepted price being rejected. If the market's that strong, there's no way we should get below B's low. And we didn't. We went back up. We ended up raising POC. They even tried again in J or K. And I remember buying more, but not as much. And then we probed. So keep in mind, this is all after the fact. Granted. But ask anybody in our trading room. These trades are all being told to people before they happen. Specifically on every day. I said if we pull back, I will be looking for longs. I didn't say it here. I said it up here. When E was an inside bar, I told the room, if the market's getting too long and they're going to shake out weak longs, I will be looking to get long. Not up here, here. And I did. I'm always looking for the next trade based on things. And that's why, we use these terminology in the room. I like to say I want to be the lion waiting in the tall weeds. I don't want to run all over the Serengeti trying to catch my prey. Trying to chase these algos is like, and I use this a lot, is like running around trying to catch a squirrel with a fork. Not going to happen. But if you're laying in the tall weeds and all of a sudden a herd of gazelle come by and the weakest one is lagging behind, and this is the weakest one here because now this the weakest long's getting out, and now I know my risk reward is getting better and better, well, I'm just going to snatch out of those weeds and grab them. Doesn't mean I'm going to be right, but the odds and risk reward are a lot better than chasing them all over the place. So that's another thing to keep in mind. Now, let's go to the 23rd. And I hope all these examples are helping. I'm going to go over different terminology and things of that nature also, and what we talk about in the room. So the 23rd was a perfect example of longs getting nothing along with lower value. Okay? Very important. We always put things in context, and this is another reason I will never ever say we have a trend day up or down if there are not single prints. Doesn't mean the market isn't trending that one way, but it is not a trend day up, and this is a perfect example of that. So the next day, we open. We had a very good day, and this is another beautiful example of two different days and the contrast of what took place. So I was incredibly confident buying G's low here on the 22nd. Now look at the next day, how it changed. We open all the way down here. Look where we closed. Now keep in mind, this is what I'm going to talk about gaps. A lot of people, not a lot, but there are people who think that this is where we closed and we open here, that's a gap lower because you're gapping from the settlement. I think that's, look, like I said, if it helps you, be my guest. That is not a gap. Plain and simple. Why? Because you're trading inside the day's range. If you use settlement as a gap, you're going to be gapping, unless you open exactly at settlement, you're gapping every day. To me, that's pure silliness. We traded all of this range yesterday. That's not a gap this opening. If we open below here, that's a gap. And the gap gets filled when you get back to the day's low, not to settlement. So this is not a gap. What it is, though, is definitely telling you something changed, right? What changed? Well, a lot. We took back, remember, we had 11 wide. That's a very, very wide point of control where buyers and sellers are happy to do business. It doesn't go away. So here's a perfect example. We open here. The single prints are gone. We're now in the lower distribution, but the POC's not gone. The POC is not gone. It's now an upside destination. So we opened here into the lower distribution, and then the market attempted to rally. Remember I said how good a job is it doing? B went up, C went up, D went up, E inside F. Wow, we're one time framing up all day into the first afternoon bar. Buyers are coming back. Except for a couple of things. Yeah, we took out the IB high. Yeah, we're one time framing up. But now let's look at the other side. Value's lower the entire day so far. It was up here at that point, but it was lower. No trend day. Remember, what doesn't happen is just as important as what does. If we had single prints that held, well, then the odds of getting that POC were very good. We didn't. So, whereas I couldn't wait to buy this on the day before, I couldn't wait to short this the next day every time it popped up. Why? We were getting no distance away from previous highs after B. Look at C. Look at D, E inside, F was a quick stop run. It literally went for about 2 seconds and down. Do you see the context of trading? Where I was dying to buy this, and the next day I was dying to short the new highs because we weren't getting anything. Tells you everything about context. And what happened after they didn't get anything? F took out E, G took out F, H took out G. They just gave it all up. Once you take out now the IB low, so now we took out both sides of the IB, shorts piling. Now, what did shorts get in H, I, J, and K? Not a lot. They never went trend down, did we? So then they attempted to shake out the shorts in J and K. Didn't get much. And that turned into an afternoon. Well, you know what? I wasn't going to use that as an afternoon rally high because the first afternoon bar made a new high in the day. But that was also a very critical level. It was right at the time the 200-day moving average. And then once we alleviated some of the shorts and no new buying came in, what happened? They rolled over and they went out with a price probe. Now let's go to the 24th quickly. This is another day with a price spike and a price probe. Again, and look, repetition is a key to becoming a good trader. You might hear me say these things a million times. You have to beat it into your own head. You have to keep seeing these things happen over and over again because just like every snowflake is different, even though these setups look the same, so many of them are different because of the context of the day and what the indices are doing and everything else we talk about. So here's another day where the market didn't know what it wanted to do. We closed at the lows the previous day. We had a price probe. But look what happened. We opened the next day here. So from K's high below, the market was short, right? We opened pretty much up here, so shorts are a little nervous. They're not scared yet, but they're pretty nervous. The price probe's rejected. B goes up. C comes in a little bit. Back and forth through the opening. We got above K. The shorts are like, well, at the time, value's unchanged, right? We're inside of yesterday. They're getting a little nervous. Well, what's going to set the shorts over the edge? What D did. Why's that? Well, now you're way above where everybody is short. You're getting above the previous day's value high, which means our value for this day is going to start getting pulled higher. And what happens? Boom. Massive short covering and momentum buying. Didn't last long, did it, initially? Look at that, D and E. You know how many shorts got hurt? And then you know how many momentum buyers got hurt? Because look what happened right after that. F and G just wiped out the momentum buyers. But look where G stopped. Never got near K's high. So where all the shorting started taking place yesterday, they didn't even get there. So again, that turned out to be a nice afternoon pullback low. Not a textbook one, but by that time, value's higher. Now the POC wasn't raised yet. It might have been raised at that point. No, it wasn't, because we're only 3 wide here. So the POC hadn't been raised yet, and that was key to me. I remember saying to the room, I said, if G goes back down to A and we go 5 wide, all that happened was short covering, weak buying, and they gave it up, and we're right back to what we're doing. So this was very important. You see the context? I don't want to get 5 wide down here. I want to raise POC. Well, we eventually did. And once we raised POC, what happened? More momentum buyers came in. And then we went out with a price spike. We spiked above E and a price probe. Valuable stuff. And then one other one I'm going to show you, and then we're going to get into some other things, is I showed you some rotational the other day on SPY. This is Russell. This is IWM. This is pure rotation before the market breaks down. And this is why you have to be careful on rotational days, because they lull you to sleep. So A opened in IWM, went up, came in, and then we went rotational. B inside, C tried to go down. Right, we didn't take out the IB high or low until G. C went down a little bit, back up. D inside. E tried to push right back. Look at the way they were rotating from basically the day's low to B's high. F gave one good effort up here. Now this is where you have to be careful. We talk about what's been played before affects what happens next. Well, what was being played before up here? They were shorting it. What was being played before down here? They were longing it. Right? So they had a stop run here. Once we got above B, the shorts panicked real quick. But it didn't last long. Right? But we talk about not getting lulled to sleep. But look on the downside. So we get down now. Everybody keeps buying it. Now remember, in B period, they're buying 5 contracts. C period, 10. E, 20. Because, hey, man, this is easy. This trading game's a joke. I just buy them here and they go up. I just short them here, they go down. So now G comes down. You're like, well, it worked on a 5, 10, and 20. I'll buy 50. And what happens? Doesn't work this time. Everybody who's long, boom, flushes out, shorts pile in, and they get destroyed. Most traders on these days, because they get bigger a lot of times, give back everything they made. They might have made money on 5 trades in a row, and on the one they lose, they give back everything and more. And then, boom, they went down. Not only did they go down, we went trend down. They held the trend down. After being rotational for most of 7 time frames, they went trend down. Don't get lulled to sleep. Okay, so I'm going to put up, how long are we here? Well, we're 54 minutes, so not that bad. I'm going to throw up charts for a minute and show you some stuff, but I also want to talk while we're speaking. I want to go over some things that maybe I didn't cover and things of that nature. You know, I talked about the checklist. The checklist is very important. And what I would do for all of you is write down these simple little things for bulls and bears and keep an eye on it. I would keep on both sides. Gap, if there's a gap. Value, who has it. the overnight high, overnight low. Who's winning the opening? Lowest accepted price for buyers if you have one. Highest accepted price for sellers if you have one. And the way I explain lowest accepted price, it's just the opposite for the highest accepted price. A closes, B opens, maybe only goes up a couple of cents, and then goes down and you never see it again. Okay? IB high, initial balance high or low. Are we one time framing up? Single prints. Do we raise or lower POC? I mean, these are all things. Just write them on a sheet. Get an Excel sheet and check them off. And then if you have an outside day up or an outside day down. So that's on the checklist sheet. But there are a lot of other things I want to talk about that I think you should write down. So I'm trying to think. I'm just going over my sheets here. A lot of things we went over as I did all those days and those trading days. And people ask me, well, what's my favorite trading day? And I've said this before. I love the afternoon pullback low and the afternoon rally high. I really do, especially when the indices are in my favor. Like that one day when everything was in favor of the bulls. I love that afternoon pullback low. Now, trend days, especially down, I like a lot. But unfortunately, we haven't had many over the last bunch of years that have really continued strongly on because the market's been basically a bull market. And even though we're off this year so far in the SPY, 5%? Not even 5%, 4.5%. We'll see if we're going to end up, maybe they try to get this market even by the 31st, end of the quarter. We really haven't had the sustained downward pressure that that I used to love on trend days down. But those are basically my three favorite trades. Another thing we haven't talked about, mental capital. Your mental capital and mental reserve is just as important as your financial reserve. And in fact, I want to go back. Give me 1 second. Like, here's a perfect example. There is no reason in the world to be wasting mental reserve and burning fuel in A, B, and C here. There's no conviction either way. B went up, C went down, back and forth through the opening. You lose, you burn up fuel here, this is the play you'll miss. So it's not worth it. Very, very important. Okay? Value area, I've talked about that. Value is much more important than price. Especially on a day like today, this day, where we pulled back. We didn't have single prints anymore, but we pulled back. We had clearly overlapping a higher value, which gives you the confidence in being long. Plus, the indices were still up a lot. Context. POC being raised is very important. How does POC get raised? Well, all the point of control is the widest part in the profile closest to half back. So it was down here to start because half back was down here. And half back is only the entire day's range cut in half. Okay? So once half back gets raised, the widest part, whatever it is. Now, we raised it, say, then from A's high all the way here when we got 5 wide to I's low. So when you look at that, 446.36 to 447.80, we raised the point of control by about $1.50. That's pretty impressive. It shows you that where all the liquidity is now being done is $1.50 higher. This is like home base. Buyers and sellers are very happy doing business here. But it was raised. So that gives you even more confidence on that pullback. Now, I like a 9 wide POC at the end of the day. I won't ignore an 8 wide. Look at all these 8s. But I don't carry them forward on my sheet. So the next day, like the next day, here was 8 wide. I didn't ignore it. We got it. Here's this one, 8 wide. We didn't get it. We still didn't get it, right? This was Friday's trading. Now, for tomorrow, I'll see it when we open up. But if, say, we open and go higher, at some point, if we get way away from it, I won't be carrying that forward. It's a naked POC. What does that mean? It's exposed. We haven't traded at it yet. So at some point, it probably will, but I won't have that written on my sheet. Again, these are all just different things I'm going back and forth through. So we talked about the opening and spikes and probes on my trades. Value area, I'm just going over The checklist we talked about, context. Boy, is context important. Ebb and flow. Just going through all the sheets I've been writing down all week about different things that I do both before, during, and then after the day. We went about, I'm just looking at everything. I think we covered a lot of it. Now, I do have one other sheet that I have, which is called Trading Wisdom. I'd like to go over that a little bit, and then we'll look at the charts real quick. Okay? What's important to me on the charts. So we did go over, but I think it bears repeating. It isn't the money you make, it's the money you keep. Anything I tell you, I've done it countless times. Okay? Anybody who tells you they don't lose money is just an outright liar. Okay? The key is to learn from your mistakes and try to minimize them. Okay? Consistency is the goal. It doesn't matter what you want to make a day, right? The zeros mean nothing. What matters is making that whatever you want every day. You can't make it for 3 days in a row, and then on Thursday, give it all back and more. That's just a recipe for disaster. So you have to have stops and honor them. Okay? My goal is to read the market structure to tell me to exit a trade rather than to register. Boy, oh boy, is that something I am continually working on. Let me read that again. My goal is to read market structure to tell me to exit the trade rather than to register. What does that mean? Well, clearly that means, and we could use Friday as an example. When we took out B's high, if I went long, and I was going to use the opening as my out, well, whatever my target is now, and again, I don't have the targets or destinations I had in front of me, but whatever the target is, that's what I should be waiting for. In other words, if I bought it right at A's high and we got to the middle of B and I just took it off, and I do this, believe me, a lot, most times, and I took it off only because I saw, wow, I'm making pretty good money. That's great, but B went higher and C went higher. So even if I didn't take it off, if I had a destination, look, I have no problem with you taking off if there's a reason for a destination or a reference point. But if there isn't one, I'm just taking it off because I'm up money, I leave money on the table. Now, say there wasn't a reference point up here and I didn't take it off, but then it comes in. Well, now, again, you can raise your stop. You can say if it comes back into B's range, I'm out. You could wait to D. D takes out B. You say, well, if D can't really get acceptance above B, now I'll take it off. Things of that nature. But that's a really important one. We talked about excess. Overnight inventory usually corrects itself because it's in weak hand traders. Think trade location, which minimizes risk and maximizes return. That's my biggest advantage. I think I'm very good at my trade entry, my trade location, as opposed to my exits, because I think I get out way too soon on my winners. So that's why I really need to be good on my trade entries. After volatile days, stocks tend to trade in a consolidated range. Doesn't mean it has to, but it tends to. Trading is all about odds, plain and simple. You might have the best setup in the world. Doesn't mean it's going to work. It's all about odds. Markets are very visual. What's been played before affects what happens next. We talked about that. This is a perfect example on that rotational day. Traders will do what's worked until it doesn't. Same thing. They're going to keep buying it here, shorting it here until it doesn't work. Gaps in excess are very important references. Change is occurring. When you have an inside month, week, or day, you should go with it and monitor for continuation or lack of. We'll show you that on the charts in a minute. Outside month, week, or days up or down are extremely important. Markets in balance, you should trade later waiting for MGI. Patience. Your longer time frames always trump the shorter ones. So what the monthly's doing is definitely more important than what the weekly or daily's doing. But as day traders, obviously the monthly isn't as big a factor because we're trading on a daily basis. Now, I know you've all heard these that trade the profile, but it's very true. Price advertises, time regulates, Volume confirms or rejects. We talk about that constantly in my room. And by the way, I know most of you, well, I would hope most of the people in my room and that follow me will listen to this, but I hope a lot of new people do. Remember, the way I'm talking in here, this is how I'm conveying how the day is forming every day between 9:15 and 4. Each trade has to be put into its own context. That might be the most important thing I say today. Every trade has to be put into its own context. And trend days, if they're taken back, usually happen late in the second day or in the third day. Now, let's go to the charts for a minute. We're a little bit over an hour, so it's not that bad. Again, I think this is something that you could go over and over again. So here is SPY's Daily. Now, we always talk about balance being subjective, and it is. Okay? So to me, right, I always say, and this is something, another thing I hope people really learn, that markets don't go bull bear, and they don't go bear bull. You have to come into some kind of balance first. Okay, here's a perfect example. The market was balanced here, went bull, 3-day balance, back to bull on Friday, on the daily. Now we see if we continue it, right? Here's our monthly. We've gone over this countless times. Right now we have an inside month. So if we don't take out February's high or low in the next 4 trading days, well, come April, it's going to be very important. If you take out March's high, you go with that trade and monitor it for continuation or lack of. But remember, it is a monthly. You could fail 2, 3, 4 times back into the month's range constantly to start with. So with the monthly, it's definitely a longer process. Okay? The weekly is up, and we just saw the daily. Look at the Russell. We talk about balance. Balance and excess are two of the most important parts of trading, and balance rules. Well, they're in a 9-week balance. They got close to a balance high from February 7th this past week and got firmly rejected for now. So, again, balance rules. You get close to the top of a balance, fail, you roll over. Well, then the opposite end is your destination. You slightly stretch a balance. So maybe this week they get above 209.05 by a little bit and come back in. You get to the other end of the destination eventually. Or you go through a balance and you don't look back. Okay? Perfect examples of markets not going bull bear or bear bull. Look at this. Look at the balance they were in. Right? This is a weekly on IWM. They went bear. This didn't go bull. All we did was go back to balance. So they went balance, bear, balance, and boy did they go bear. Right? Then they balanced. They're not bull yet. Right? This month took out this month's high. This month was inside. I would have called this a week. I would have called this a 3-week balance. Then finally you came out of it to the upside. Why is this important? Because people are always trying to pick a top or a bottom. Right? And they're constantly getting hurt. Look at this trade. Okay? Even if you didn't catch this week, now I know these are extreme examples and stuff, but even if you didn't catch this week, who cares if you missed the first $10 of a move? Right? It went down another 50 points. If a market is truly breaking out of balance, and that's why this is going to be so important in IWM when they do. If it's truly breaking out of balance, you're going to get enough of a gain. Here's a beautiful example. This is the monthly on Russell. They spent, a year? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 months in balance. They exploded out of it by $11. Spent no time up there, though. In fact, Where is that? Here it is right here. They exploded out of it. Spent 1 week, 2 weeks. That's it. But you're going to have the time to get on board one way or the other when you break out of that balance. Now, I did have a couple of other things real quickly. I'm not sure if they're going to show up on here, though. Let me see. Nope, doesn't look like it's working. Okay. It's not. So let me go back here and finish up. So it's an hour and 10 minutes. I know we went over a lot. So here's a couple things. Hopefully you're still with me. Again, go slowly through this. My email is paul@camelbacktrading.org. If there's something I didn't cover in here, please email me, whether you're in my room or not. Okay, if you're in my room, I'll go over it one day in the trading room. If you're not in my room, hopefully you'll join. But if not, I will go over it on one of my videos that I post on YouTube. Okay, on Twitter, at Paul Asmar and the number 5. My Paul Asmar on YouTube. And again, my website is camelbacktrading.org. It's $30 a month. I think it's the best thing to come. I think it'd be the best $30 you would spend to come check us out. Not only me, we have a great community in our room. So you could come and check us out. I really appreciate all the likes and people subscribing to my YouTube channel. Again, if you like what you see, please pass it on to your coworkers, friends, family. Even if they just sign up on the YouTube channel, maybe once in a while watch them and give me a like. Hopefully it'll help educate people. That's strictly what I'm doing in my trading room and on these videos, to try to educate and be informative so people have a better chance of being a successful trader. Enjoy the rest of your afternoon. And for those of you in my room, I'll see you tomorrow morning at 9:15.